Good day, everybody. This is Scott Gillum with your Lesson 5 for beginning options traders. And today we're going to talk about the credit spread trades. Before we begin the discussion, let me remind everybody all rights are reserved and copyrighted for ShadowTrader for 2022. The content in this presentation is presented for educational purposes only. It should not be considered as a recommendation to buy or sell a security. All information is not investment advice, and option traders or trading options involves risk and may not be suitable for all investors. All rights and obligations of the options instruments should be fully understood by you, the individual investor, before you enter any trade. All right, today, topics. We're going to talk about the put credit spread trades as well as the call credit trades. We're going to talk about what's called a bullish put spread. Some people call it a bull put, but it is a vertical put trade. We'll talk about the endpoints. We'll talk about some strategies and adjustments. Then we'll flip over to the call side, the call credit spreads. These are bearish type of trades, sometimes referred to as a bear call. Once again, endpoints and strategies and adjustment possibilities. Let's start out with the put side. Put credit spreads. What are they? They're a bullish type of trade. It's a bullish spread trade using two options with a bias to the upside for the price of the equity. This is sometimes referred to as a bull put, but what it really is a put vertical that you're selling. All right, let's understand the instruments that we use. Well, we're going to use the put side. We're going to also talk about applying the strategy. Where would you put this strategy in your portfolio? i.e., where on the chart would you look to add this type of trade? We'll look at some exit points, some strategies for adjusting this if things go wrong. So, first of all, the bull put. I'll use that term. It's going to optimize a bullish trend, but it can also use a stagnant trend to be profitable. Our primary instrument is the short put, selling a put option. Then we limit our risk by adding a long put. So the first instrument, the short put on a sale, the second instrument, a long put as a purchase. The expectation for the equity price movement is bullish. Both of these options are in the same expiration series. Recommendation for time to expiration. My recommendation is less than 30 or 30 to less than 30 days of time, because we don't know what the trend could be, and the shorter the time frame, the greater the chance of profitability. Our long put is a risk-limiting instrument. It risks us less capital. The trade risk is going to be the strike differential, difference between the two strikes. So let's say you've got a 100 strike option as a put, and you've got another one at 95. Well, the 100 put that you sell and the 95 put that you buy gives you a $5 differential. That's the trade risk itself. Now, the credit that you receive from this trade is going to offset some of that trade risk. So let's go back to the example. You sell a 100 put, you buy a 95 put. And for that transaction, you pick up $1. Well, you've got $5 difference in the spread, and then you subtract that $1 of credit that you received up front. Therefore, your trade risk would be $4. The maximum potential in this trade, that's just the credit that you receive. In the example, you receive $1 on a $4 risk. That would be how you would calculate your risk over return. The primary exit for this instrument, for this trade, is to have it expire worthless and keep all the credit. There are secondary exits that you should plan for. If things do not go in your favor for the trend, i.e. not stagnant, not bullish, a good secondary exit would be to close the trade at a percent of that credit that you have remaining, a net gain, or you can adjust into another type of spread trade. And that all depends on the action of the underlying equity. So let's take a look at a setup. The bullish put spread setup, a bull put, a put vertical in a bullish fashion. First of all, first instrument, primary instrument, we're going to sell the 195 put. For that, we're going to get a credit of $3.50. Well, that gives us $195 of total risk, all the way down to zero. I don't like that. So we're going to buy then a put below the strike of the short put, and for this example at 185. Well, I get $3.50 in my pocket, but I have to expend $1.30 for that risk limiting option. That gives us a $2.20 net credit on the trade. In a single transaction, this is what it'll look like on your brokerage platform. You sell a vertical, the date of expiration here, July 2019, I'm sorry. A 195 short put and a 185 long put combined gives us a $2.20 credit. Here's what it looks like on the chart. You're going to sell this 195 and you're going to buy the 185. Your trade risk, well, the strike spread, the spread between the two strikes, is 10 points or $1,000. The credit that we received was $2.20 or $2.20. That gives us a net trade risk of 1,000 minus 220 or 780. The maximum profit, once again, is the credit that you receive or the 220. This results in a 27% return on your risk. How about some exit points? Well, if the stock goes bullish, that's one of your primary trends that you want the equity to trend to. That gives you profits. So your primary exit becomes your first exit point to look at. Second exit point that you're going to want to watch is you could close it early to capture some of that credit, or if it's still going bullish into expiration, you can allow this to expire worthless to keep all of the credit. Well, if the stock trends stagnant, depending on where you put this to the stock price on the initiation of the trade, a couple of things can happen. You could allow this to go worthless, which would be a primary exit. You could take partial profits as your secondary exit, or if the short put is in the money, that means that it's slightly below the price of the short put. You could close the trade or adjust it to another type of trade and possibly into a collar trade by doing a few other transactions. Now, if the stock starts to go, or the equity starts to go bearishly. That's a trend that you don't want. Your secondary exit comes into play. Close at the break even when you've given back all of your credit. Or you can also do additional trades to adjust it to a collared trade, or you could close it at a loss that you predetermined. So once again, primary trend is bullish. Can also work in the stagnant trend. Does not work and needs to be adjusted in the bearish trend. Some considerations. I'll read this. The bull put. It combines a short put and a long put. The short put is placed at a higher value strike price than the long put in the same expiration month, preferably using current month or less options. Big question is, where's the risk in the trade? Well, the risk in the trade is in that short put. We have an obligation to buy the equity at the strike price of the short put. Once again, obligation. To mitigate that obligation, we have bought a long put, so we have the right to sell the equity at the strike price of our long put, thus limiting our risk. Our risk is the difference between these two actions, the obligation and the right. The one thing that softens the blow if things go against us is that we get to keep the credit of the trade, which may not, and most times does not cover the difference in the strikes. The short put is best placed at or below a support level on the underlying equity. That should be your primary objective. Find a support level where the equity will not go to within the time frame of the trade. Pardon me. A caveat here, do not place this trade during an option series where there's scheduled news, such as earnings, such as a meeting, such as a Fed event. That gives you a higher level of loss in the trade. Repeating once again, the long put is used to minimize and control our risk. In some instances with equities, you can do spreads as little as 50 cents between the two strikes. All right, let's take a look at a profit and loss graph of the bull put. First of all, I've got the first line here is analogous to a short put. I'm selling the right, I've got the obligation to take the equity should it fall below a current level. And at this point, it's a 75 price. So I have profit 75.01 and above. I have losses below the 75. But I get a credit, so I can reduce that by the amount of the credit. In this case, about $2. There's your short put strike price. And now let's add in the long put. The long put price or strike price is down here. I'm going to sell the 75. I'm going to buy the 70. Adding those two options together, what do I get? I get risk when it falls below the difference of my two strikes minus my credit, or in essence 75 minus 70, $5. And let's say this is a $2 credit. So below the 73 price, I start to lose money. I am rewarded for my trade when we are above the break-even point at $72 at expiration. Here's a term that I just used, theoretical or break-even point. The theoretical break-even point is the point at which you've given back all of your net credit you received when you opened the trade. Sell the 75, buy the 70, $2 credit, $73 would be your break-even point on this example. Mathematically, here you go. It's the strike of the short put, 75, minus the net credit, $2, would be 73 net. Now, in that example, it was different. 75 minus a 55 credit, all right, 74.45. My example and what's on the screen differ, but you get the point. All right, the conclusion. Bull put is a trade that optimizes a stagnant to bullish trend using put instruments. The primary instrument is that short put. Our risk limiting instrument is the long put. My maximum reward is the credit that I receive on the transaction. The risk is the difference between the two strikes, so the long and the short, minus that net credit that you received. A secondary exit, follow through on your short put obligation, i.e. buy the equity, and then move into what's called a collar trade, or to simply close the trade. Once again, graphical representation of a P&L. Short put on the right, long put on the left. The blue line is the expiration valuation. The beige line is the current valuation of this trade. Moving on to the other side of the options chain, let's go to the call credit spreads. These are bearish types of trades, so we call them a bear call spread setup. Sometimes just called a bear call or a bearish call vertical. I know, it's confusing. Once again, we're going to understand the instruments used. We're going to take a look at those. Where do we apply this strategy, or why would we apply the strategy? Some exit points we want to look at. Strategic adjustments if things don't go our way. So, first of all, the bear call. It optimizes a bearish or stagnant trend. Think about this. The equity has moved up, 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 and up, and has gotten to a point where it's too far above its level to hold on to price and starts to reverse. Price starts to retrace. That's a reversal. That's a good area to look at to possibly put on this type of trade, this bear call. Our primary instrument is the short call that we will be selling, or the call that we will be selling as a short instrument. Now that sale of a call has unlimited risk, we want to mitigate that by adding the long call. The expectation on our equities price movement is bearish. Once again, both options are in the same expiration series. And once again, a recommendation that you use 30 days of time value or less so that you can have a valid trend to be monitoring. The long call limits our risk in this trade, also limits our margin that we need to do the trade. The trade risk, just like the put side, the trade risk is the differential in the two strikes minus our net credit that we received. The maximum potential reward, or the full reward, is just the credit that we received when we opened the trade. Primary exit. Well, the equity continues to fall in price. we get to keep all of the credit and the whole trade expires worthless on expiration. Secondary exit. Equity doesn't do what we want as far as coming down in price or stagnating and starts to climb once again. Secondary exit would be to close this trade at a % net gain, some of your credit, or adjust it into another type of spread trade. Here's what the trade setup looks like. I'm going to sell a July 200 call, which has unlimited upside potential and therefore unlimited risk, but I'm going to sell that for $4.75. Now, to limit that risk, I'm going to buy a call above the strike of the one I sold. I'm going to sell the 200. To limit my risk, I'm going to buy the 210. So I get $4.75 for the sale. I have to expend $135 on the purchase. The net of this trade is a credit of $3.40. So I'm going to sell a vertical 200 210 call trade. The difference in the two strikes is my maximum risk. That's $10. That's $1,000. But I got $3.40 or $340 of credit by entering into this margined credit trade. Net net, my trade risk is $660, and I can make a profit maximum of $340. In this example, I have a 50% plus, 51.50, return on my risk. $3.40 of credit on a $6.60 risk. All right, let's take a look at some exit points. Stock goes the way we think, bearish. All right, the primary exit. Primary exit would be to take a profit early and take some of the credit in hand and get rid of the trade. That's a % return. That being, let's say, 50%, 75%, whatever, the primary exit comes into play. Also, if it continues to go bearish towards that expiration, you could allow the whole trade to expire worthless and keep the entire credit. In a stagnant trend, putting this on with your strikes outside of the current price, your primary exit of taking full profits at expiration if the options are out of the money, or taking partial profits if you're very tight for your strikes to the price of the stock towards that expiration date. So you've got a primary or secondary exit as your exit points. Now, on a stagnant trend, depending on how you put this together, if that short call, though, is in the money by only a penny, but time is very short, you should be able to close this for a partial profit. If it's not, possibly look to adjust into another type of spread trade if you're being squeezed at expiration. The worst trend, or the trend that does not work for this bull or bear call, is a bullish trend. You start to climb in price above your short call. Well, your secondary exit comes into play. Either take partial profits or exit the trade at a percentage loss from the credit you received. Another alternative would be to adjust this into another type of spread trade. Make this from a bear call into a bull call, or possibly buy the equity prior to expiration, have it called away when the short call is exercised, and let the long call continue to run. Many options for adjustment, both in a stagnant or a bullish trend. All right, let's talk about some considerations about applying this bear call. First of all, it combines the short call and a long call as a single trade. The short call is placed at a lower value, a lower strike value that is, than the long call. They're both in the same expiration month. Preferably we use 30 days or less as an expiration point. We're going to look for a relatively weak stock. That doesn't mean a weak stock as far as it doesn't make money. That means a weak priced stock, one that has gone up too far and cannot hold the price level that we're going to put the trade on at. Using less than 30 days or 30 days or less gives us the ability to get a fine tune on the trend. We apply above resistance typically to improve the probability of this being a successful trade. Once again, the example, price has moved up too far too fast and is starting to come back down. It's hit resistance, it's rolled over, getting back towards a normal price. Once again, beware of news events. News events can exacerbate price movements. Do not place this prior to an earnings event. That's an unknown, and at an earnings event, as you've seen in a lot of your trading, price can move drastically. The primary exit for this bear call is to allow the options to expire worthless so that you get to keep all of the profits or all of the credit. Secondary exit, a good one would be to close early to minimize the loss as the equity moves in the wrong direction, or to adjust this into another type of spread trade. Let's take a look at the profit and loss graph. This is our short call. There's your strike of your short call. As long as I am below my strike on the short call, I am profitable. We've also got a point here where the zero profit line is. That is the credit received from selling that call option. Your strike price is there. Now let's take a look at the long call strike price. The long call strike price, is down here at 75. I sell the 70 call. I buy the 75 call. The 75 limits my potential risk. The long call strike, the short call strike. I get a credit for this transaction, and that is the point where price crosses the zero line, or pardon me, the equity price crosses the zero line. I have reward if the equity stays below, and I have risk if the equity moves above that break-even point. Once again, the theoretical break-even point is the point at which you've given back all of your credit in the trade, and it is mathematically the strike of the short call, 70, plus the net credit. Well, let's say it's, in this case, it's 55 cents. So at $70.55, I have no profit, I have no loss in the trade. That's my break-even point. Once again, the heavier lines on this P&L graph are the price and profit at expiration. The thin curvy line is the profit and loss graph at the current time that the trade is put on. The bear call is a trade that optimizes both a stagnant or bearish trend using the call options. Our primary instrument is the short call. We need to limit the risk because it's unlimited to the upside, so we have added a long call to the trade. The maximum reward in this trade is the net credit we received. And the maximum risk, how we figure that, is the difference in the two strikes that we've used, here 70 and 75, minus that net credit in the trade. A secondary exit, or if things go bad, is to simply close the trade for any credit or a minimal loss, or to look to adjust using longer-term long calls, buying the stock, or a multiple of other trades as a secondary exit. And that concludes the option lesson for credit trades today.